Hello and welcome to Ask You for a Trend. For the next half hour, we are breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. It was a mixed day on Wall Street after continued tariff uncertainty and after Monday's sell-off on those trade war jitters. At the end of Tuesday's session, down the S&P 500 ended lower. The NASDAQ closed up. And with renewed uncertainty, are retail investors still in it to win it? We're taking a deep dive into which stocks people are buying and selling and how much risk they're willing to take on. And gamblers are rolling the dice in hopes that Trump's big, beautiful bill won't hurt their bottom lines. We're looking at some surprising impacts the legislation is having on the world of betting. Well, as volatility creeps back into the market and uncertainty builds, retail investors, they're still playing at ball, but with some caution. Joe Mazzola, head of trading derivatives strategist at Charles Schwab, joins us now. Joe, it is always great to have you on the show. Maybe start big picture, Joe, because you've been watching these markets for a long time. We had that big, powerful move off the April low, Joe, the move, the speed of it, impressive. And then, of course, we had the big, beautiful bill. We got Trump still making headlines on tariffs. Joe, where do you stand on this rally?
Josh, if we would have gotten these last 2 days of news back in April, I'm assuming you'd probably see an 8 to 10% pullback in the market. So it just seems like, the market's able to digest some of these headlines much easier than it was a couple months ago. And part of it is because it's developed some calluses, I think, if you will. We saw the 20% or basically 19% pullback on the S&P 500, then a 22% rally back and, setting all-time highs. And so, I think market participants at this point are still, bullish, but I think that they're cautiously bullish. But I also think that, they're de-risking a little bit, and maybe some of the momentum names that I know you guys were just talking about a little bit, maybe they're looking for other sectors, other areas. We've seen clients move into discretionaries. We've seen clients move into industrials and start to maybe kind of fade some of their positions in technology. And I think that makes sense. There's nothing wrong with, with trimming some of the winners when you get that snapback rally.
Q2 earnings, Joe, now on deck. Mm-hmm. I'm just interested to hear what you expect there, because I know you say, Joe, looks like the bar is set relatively low here.
Yeah. I mean, I think it's at 5.8, maybe 6% year over year expected earnings. And if you go back to Q1, that was about a 14% year over year growth. So the bar is set pretty low. It should make for an easy hurdle to overcome for the majority of the companies. I'm not paying attention necessarily as much to the flash number as I'll be paying attention to the guidance. I think, Josh, that would be the thing that viewers really should be keying in on is not necessarily what do companies report, because if you think about it, you're going to get very little of that tariff effect, right, in the Q2 data. You're going to see a lot more of it in Q3 and Q4. And so what are companies doing to be able to maintain those profit margins? There have been a few companies that have already reported for Q2, and what we've seen is, a few of them have talked about revenue beats, and the revenue beats are actually extending beyond the profit beats. And the reason that you're seeing that is because you're starting to see some of that squeeze in those margins kind of going forward. But it's a very small handful at this point of companies that have reported. We're going to have to be really paying attention to technology and kind of see, what comes out of those, the guidance going forward there.
I'm curious, Joe, as you put it, and I like that, how investors have developed some calluses maybe when it comes to that hot tariff talk. If you saw another pullback or correction here, Joe, in the near to intermediate term, I'm just interested to hear how you think folks might respond and react to that. Do you think they would just jump right back in, Joe? Would it be buy the dip?
Yeah, well, I mean, until we see otherwise, Josh, that's been the theme. I mean, if I look at the top buys, Tesla, Palantir, and Amazon, Tesla, so I can break it down on a weekly basis. So when we saw the week of the feud, and then also the poor sales data come out, you saw Tesla pull back 15%. That was the week where we saw the majority of the buying for the shares from our clients. Palantir had multiple times where it had 10% pullbacks in June. Those were buying opportunities. Amazon's been a little bit more slow and steady, not to the same effect. But, the sales, which is interesting to me, is NVIDIA selling the rips on that one, pushed to all-time highs. And Josh, this is a stock, NVIDIA, that if you look over the past 24 months that I've been part of this stack study, it has been the number one buy for 22 out of the last 24 months. The only two it hasn't been, the last 2 months. And those are, that kind of shows this indication that clients are moving out of maybe some of those, some of those big winners and looking for opportunities where maybe some of the stocks haven't had quite the same momentum to the upside.
So, and you always have such a great line of sight into retail traders, Joe. And so for those Schwab customers, how would you characterize the sentiment right now? I mean, would it be cautious?
So the stacks itself really measures activity, right? So you can look at sentiment from an activity, and you also look at sentiment from when we ask them, when we poll them. From an activity standpoint, what we're seeing is a few really interesting things. We're seeing, mildly bullish sentiment, but we're seeing de-risking. And, part of that, Josh, is moving from single stock allocations into ETFs and mutual funds and fixed income. That's been a trend. We're also seeing, margins. Clients aren't levering up maybe to the extent that they did prior to April. And then the other thing is, too, derivatives from the option space. We're not seeing a lot of the upside call buying. At the same time, we're not seeing a lot of the downside put buying either. It's just kind of, waiting it out to maybe to see kind of what the tariffs look like. And remember, this was June data, right? So they were kind of doing this in advance of July. Now we've got the another reprieve till August 1st. So we'll see if that activity carries forward. I think that's fairly interesting. And then when we actually ask them, when we poll them, we say, hey, how you feeling right now? We did see a nice little uptick from May into June in terms of that bullish sentiment. What clients are telling us is that, they're willing to stay in and buy the dips, even on the Mag 7s, up until, they hear otherwise from the tariff and the trade policy. That might be the one thing that could maybe change their mind. They do expect more volatility towards the end of the summer, because when you're looking at a VIX that's trading sub 17 with all of the data that's going to be coming out in the next 30 days, whether, it's the August 1st expiration, whether it's earnings coming out, whether it's the next Fed meeting, there is plenty of stuff on the plates for investors to have to kind of manage. But interestingly enough, it's just they're not reaching either way. They're not reaching for protection. They're not reaching for upside.
Joe, always great to see and to have you on the show. Thank you, sir.
Thanks, Josh.
Stick around. Much more Ask for a Trend. That's still to come. The Dow and the S&P 500 slip as President Trump stays firm on an August tariff deadline. Here with the trading day takeaways, we got Yahoo Finance's Allie Canal. Allie.
Hi, Josh. Yeah, so we had a lot of developments on the trade front. I would say we heard from the president a decent amount, but we didn't see too much of a reaction for the major indexes. That being said, we did see a pretty strong reaction in copper prices, and this comes after President Trump said he would be implementing 50% tariffs on all copper imports. That joins the 50% tariffs we already have on steel and aluminum. So you saw copper futures soar over 10% earlier on the announcement. We did come off of some of those highs, but we were still up around 9% at this point. Now, Trump also threatened as much as 200% tariffs on pharmaceuticals. We did see most of those pharma names close in the green, although if you take a look at a company like Pfizer, for example, we saw a bit of a dip here around 1 p.m. and then we were able to recover. So we know that markets have largely been looking through a lot of this tariff uncertainty. They've been relying on the taco trade. Trump always chickens out. And to that point, that's led to more bullish optimism on Wall Street. And we have seen a few strategists up their price targets for the S&P 500. Goldman Sachs, for example, is now at 6,600. Bank of America is at 6,300. Now, based on where we are today, that doesn't imply too much upside ahead. And Bank of America is saying that at this point, they don't see a ton of near-term catalysts that can really support this meteoric rise that we've seen in the S&P 500 since those April lows. Like you're saying, right around the 6,200 level. Again, Bank of America is at 6,300. That being said, though, the firm said you can't discount corporate America, and they've been really able to insulate themselves from a lot of this tariff uncertainty. So we'll see where stocks continue to trade in the future. Goldman Sachs says that large cap companies, they should continue to outperform, and we should have a solid earnings season. So that'll really be the near-term catalyst.
Yeah, I mean, now we wait for earnings season, how much of a positive catalyst that can be, right? You get back off DC maybe a little bit and actually listen to CEOs and CFOs, how their companies and their markets actually performing.
100%, and that'll be nice, right, Josh? A little bit of a deviation here, but so far we have not got that. And to that point, a big debate on Wall Street and even for President Trump is to cut or not to cut. We heard a little bit from him at the White House earlier today. No surprise what he said, but here's a look.
That he should resign immediately. We should get somebody in there that's going to lower interest rates.
Do you want congressional Republicans?
Why don't you go for his resignation?
Do you want congressional Republicans to investigate and pursue?
Okay with me. I think he's terrible. I think, look, we're paying, I call him too late. T-O-O, too late. Like Too Tall Jones for the Dallas Cowboys, right? Too late.
Too late, pal. This is something that we've heard President Trump refer to the Fed chair multiple times.
That's actually one of the nicer things he said about him.
Yes,
truly.
nicer things he said, certainly. But we know that potentially we're not going to get any of those rate cuts. And to that point, it was interesting to look at what markets are projecting here. They are still pricing in that September rate cut, but the odds are now at 63. A week ago, we were at 73. We did get that solid labor market print last week, so that is sort of painting a picture that maybe we won't cut for bad news at this point. But that brings up something that I've been noodling on as well, is if we do cut for bad news, a deterioration on the labor side or the growth side, that's not going to be a good thing for equities. We really want to cut for good news, and that's if we can see inflation steadily tick downward. We'll get another update on that with the consumer price index next week. But a lot of commentary on Wall Street basically saying we're not going to see that, especially as tariffs continue to work their way through the
Powell's
system.
made it clear he wants more clarity on that tariff inflation.
Wants to wait.
Wants more. Thank you, Allie. Well, stick around. Much more Ask for a Trend still to come. Breaking news coming from Apple announcing a chief operating officer transition. Jeff Williams is stepping down from his role as COO later this month, and here with more, we got Yahoo Finance's Dan Howley. Dan.
Yeah, Saban Khan's going to be taking over previously the senior VP of operations, but I think the broader thing here is that Jeff Williams was largely kind of seen as Tim Cook's potential successor. He had done everything from lead operations to have the design team report to him, worked on health initiatives, the Apple Watch, everything from the iPhone to the iPod. He was in his 27th year, and it really did seem as though it was leading towards him eventually becoming CEO of the company. Now, not so much that he's heading out the door. I think one of the things to consider is not only is this a major loss for the company, but it also points to the number of kind of defections we've seen from Apple. This is obviously defection, it's retirement, but the folks who have managed to kind of move out of Apple as of late. And it's been a huge number. On top of that, we just had Meta scoop up their head of foundational AI models. And so it does feel as though Apple is in quite a transitory period where they're going from kind of this relative stability with their leadership to this time where they're going to be transitioning to perhaps a different set of heads at the company. We'll just have to see what that means for the future. Tim Cook, the design team, will now report directly to him, so it'll be interesting to see how that all shakes out. But yeah, I mean, a wild kind of piece of news on a Tuesday.
To your point, Dan, I think if you asked most people who they thought was going to take the reins, it would be Jeff.
Yeah,
right? I mean, you're the guy who's running operations, knows the company inside out, tested veteran. I mean, you can argue, top three, maybe the second most important person there in Cupertino.
I mean, what did Tim Cook do before
exactly.
he was the COO, right?
Yeah.
I mean, he helped develop the supply chain there. Williams kind of came in, continued on with that. And so, I think that's part of the larger reason as to why they thought why everyone thought that he would be the kind of go-to. But, we'll just have to see who among the remaining leadership would be up there. Obviously you have Jaws, who's still there. Craig Federighi.
Red Jaws Red.
A dark horse, maybe, Craig Federighi.
Software head.
He could be the person, or Eddie Q, obviously, who is currently the SVP of services. Those are really some of the folks that I think, really stand out. Federighi has that kind of pizzazz factor. He's always out on stage. So it would be interesting to see him do that. But really, we just kind of have to see where they go now.
Big news on a Tuesday. Thank you, Dan. Appreciate it. Well, President Trump calls it his big, beautiful bill, but gamblers may see it as bad bet. A new tax provision is raising eyebrows across Vegas, Wall Street, and sportsbooks apps alike. For more, we're bringing in now Jordan Bender, Senior Equity Research Analyst at Citizens. Jordan, it is great to see you. So walk us through, because this certainly made some news, Jordan. It got some attention. The big, beautiful bill, Jordan, and how it could affect bettors.
Josh, good to see it. Yeah, normally gambling is done on a state level, and for this time we get a federal adjustment. So in the big beautiful bill, the tax now says that if you are a winning gambler, you could actually be subject to more tax than you actually make in a given year, which for some people that's pretty impactful. Now, for the companies we cover, we put out a note Sunday night that kind of broke down maybe why this isn't actually all that bad. It is a negative. We just don't know where it's going to land between this is neutral and this is really bad for the industry, for the reason that if you take the product offerings of gambling, let's just take poker, for example, the companies we cover like DraftKings and Flutter, they don't have that much exposure to poker in the US, where if you are a professional poker player, this is going to hurt you massively because you are now subject to more tax than you actually make in a certain year. To look at it from a higher level, we all know casinos don't lose. And that's kind of the mantra we've taken here is if you're a sports betting company, you don't want winning players actually on your platform. And that might be saying the quiet part out loud, but these are people who are losing on these platforms who would not actually be subject to these taxes. So we think that a lot of the uproar that's happened over the last couple of days around it's going to kill the gambling industry are definitely overblown at this point.
Do you think, Jordan, this could, though, in theory, motivate more bettors to move to offshore, unregulated sites and platforms?
Yeah, look, gambling and online gaming are built to give you the best experience. It's an entertainment option. And when these companies can't give you the best experience, or as a player, you come on and go, I'm not going to make as much money as I thought. The other alternative here is you go find other ways to gamble. Bettors are going to bet, whether they're on the legal market or the illegal market. So, one of the examples that we like to give is Illinois raised the tax rate now twice in 2 years. And we have data that shows that people are actually going from the legal market to the offshore market, just given these sports betting companies can't give them the product that they want because they're paying higher taxes in this state. So there is truth to this that we do think people will move to the offshore. It's just the cohort of people that we're talking about here are a fraction, maybe even of 1% of the total industry.
And Jordan, while I have you, I want to get your take. There was this report in the Journal I want your take on how spot fixing, they say, is coming to American sports. So you're talking about manipulating these kind of small, discrete events, timing of a yellow card in soccer. How could that affect the sports books?
Yeah, look, these situations happen. They've happened a lot since, essentially online gambling has been legal here in the U.S., but it's happened long before that. There's kind of two ways to look at this. One is, we all see marketing. We all see DraftKings and FanDuel across media and print and on TV, and it's bringing more people into bet, which is causing, if you want to call it, more problems. On the other hand, those problems have always been there. It's just they've been masked by, states not being legal. So if you look at the other side of this is if you legalize sports betting and iGaming in the US, you're putting in the framework to catch people and get rid of these situations. So we always, we come on here and say, we like Genius Sports, we like Sport Radar. These are actually the companies that are the ones, with integrity solutions that are catching these happening in real time. So it's a balance of, companies are promoting more, bringing more people into the industry, but at the same time, it's being cleaned up and it's catching these instances as they happen.
Jordan, always great to have you on the show. Thank you, sir.
Thank you.
Well, that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.